Good afternoon, and welcome to the May 2023 Executive Committee meeting of the Board of Education Retirement System. Today is Thursday, May 18th, 2023, and the time is 1:10 p.m. As a reminder, please note that the committee meeting is being recorded and will be posted to the BERS YouTube channel. Start the meeting by calling the roll. Cherie Gibson.
Present.
Thank you. Anthony Giordano.
Present.
All right. John Matterich.
Present.
Russell Buckley.
You just signed off, I saw, Antonio.
You signed off? All right. We have a quorum. I'd also like to note for the record that alternate executive committee member Gregory Faulkner is in attendance, and board members Allison Hirsch, John Dorsa, Lily Chan, Marjorie Dienstag, Naveed Hassan, Alan Ong, Mahisha Sapp, and Thomas Shepard are also in attendance. The first item of business is to consider the minutes from the executive committee meeting held on Thursday, April 20th, 2023, a summary of which was included in your packets. May I have a motion to consider?
So moved, Tony Giordano.
Thank you, Tony. May I have a second?
Marjorie.
I'm sorry, Marjorie, for your attendance, you're here, but for voting purposes, only executive committee members can.
Cherie seconds.
Thank you, Cherie. Any discussion on the April 2023 executive committee meeting minutes? Okay. All those in favor, please say aye.
Aye.
Aye, Cherie.
Thank you. Any opposed? Right. Any abstentions? Right. The motion carries. Before we get into our first discussion, I would like to note a few housekeeping items. First, as with the previous meeting, we will go through one item in public session, go into executive session to discuss a fund recommendation, and then come back into public session for the asset allocation discussion. In addition, after the presentation on actuarial assumptions from Chief Actuary Merrick Tiskevich, Executive Director Sandy Rich will give the committee an update on the budget. Finally, and as I said previously, we are planning for the next executive committee meeting to be held in person at 55 Water Street on Thursday, June 22nd. Since its creation, the executive committee has always been from 1 p.m. to 3 p.m. on either the third Thursday of the month or the Thursday immediately following the joint NYCBERS manager presentation meeting. As always with the in-person meeting, we want to be cognizant of the schedule of our board members. So we're happy to keep the meeting schedule as is, but there are conflicts with doing the committee at that time in person. We'd like to hear from you all to make sure it works for everyone's schedule. So as of now, again, we are planning for the in-person meeting Thursday, June 22nd, 1 p.m. to 3 p.m. All right. Any kind of comments or questions on the any of those housekeeping items?
Sorry, I just joined Lane. You said June 22nd?
Yes, Karina, here, perfect. Yeah, so June 22nd is what we're scheduling for. So typically we'll have it on the third Thursday, but the next manager presentations are scheduled for Wednesday, June 21st. And so we always have the executive meeting immediately following those presentations.
Hold on a second. I'm just looking because it sounds like, hold on, June 22nd is a Thursday.
Yes.
Okay, from 1 to 3?
From 1 to 3, yes, that's it. What is currently scheduled for.
And you said it's a live meeting, and where is it going to be held?
55 Water Street, 50th floor.
Okay, we'll get all that as a follow-up in writing.
Absolutely.
Great, thank you.
Absolutely. All right. Any other
Antonio?
questions? Yes.
Yeah, quick. We don't have the option to choose a hybrid for trustees that might be working.
So, I mean, certainly for quorum purposes, we would need the trustees who are members of the executive committee to be in person.
Okay.
We have a hybrid option for for either alternates or trustees who cannot attend. But in order to have quorum, we do need, if the meeting's scheduled for in person, we do need a quorum on site.
Okay, thank you.
Actually, just note for the record also that Effie Zachary and Michelle Joseph, board members, are also in attendance. All right. Any final questions on that, on the scheduling or any other housekeeping items?
Oh, also noted, Karine just joined in.
Yes, absolutely. For perfect. Thank you. Okay, hearing none, we can go to the.
All right. Hey, Antonio, I'm sorry. This is Tom. Quick question. So there's nothing going on for us for the 21st, right?
The 21st is the joint NYCERS-BERS investment manager presentations.
Okay.
And so that's why we are moving the executive committee meeting to the date after. So if folks want the opportunity to hear the manager presentation, they can before voting.
Okay, what time is that meeting happening?
9:30.
Okay. No, because the 21st is our next panel meeting.
Absolutely. So yes, it's good at 9:30 a.m.
All right, thanks.
All right. Perfect. So the next item on our agenda is a quick update on the net zero implementation plan. This item is only for discussion. May I have a motion to consider?
So move, Sheree.
Thank you, Sheree. May I have a second?
Second from John.
Thank you, John. All right. Let's see, share my screen. All right. Please let me know when you can see my screen. Can folks see my screen?
Yep.
All right, perfect. Thank you. So at its last meeting, the Board of Trustees passed the net zero implementation plan, but reserved the right to modify that plan at its discretion. Several trustees requested a comparison between the BERS and TRS plans to see if there were any differences. I want to thank the Comptroller's Office for their comments and clarifications on some of those differences. And I think, really our conclusion is that there's not much divergence between these plans. Really can only find three areas of divergence. The first, as currently written for BERS, both public and private market managers have to come into compliance with regard to science-based targets by 2025. The TRS plan separates out public and private managers for compliance 2025 for public managers and an extra year 2026 for private market managers. The second is that in the divest to de-risk timetables, calls for BAM to develop criteria to guide possible divestment decisions for public and private markets. While the TRS plan just says that BAM has to report back to the board for 2025 for public markets and 2026 for private markets, but does not explicitly state that BAM is to develop criteria to guide possible divestment decisions. And then finally, the BERS plan, as passed, calls for an assessment of BERS operational emissions and for potential mitigation. And the TRS plan does not include an operational assessment. So I think really quickly, overall, there's not much divergence. But to the degree that there is, it's really about the TRS plan allows for more time for private market managers versus public market managers and eliminates the operational emissions. But I think, happy to have the representatives from the Comptroller's Office give their overview and assessment. But overall, we don't think that there's much difference between the plans, and that as currently constituted, the executive committee cannot take any action, but can certainly relay and recommend to the board for any recommended changes.
So
happy.
this is Allison. I just want to say for the record that the BERS plan and the NYCERS plan are basically identical. The only difference being that NYCERS decided to take the operations component out of the net zero plan, but is voting on a separate resolution to implement the operations piece. So they're functionally, so that is the only difference with the actual plan, but they're functionally equivalent.
Thank you, Alice.
Trying to raise my hand on this, Antonio.
Yes, Tony.
So thanks for the feedback. So essentially, you don't feel like there's anything material that needs to be incorporated that are relatively the same?
Yes, and again, the difference on the private market managers is really if you think about kind of substantially from a investment standpoint, just the difference in timing between public and private market managers versus saying that we're going to give all managers the same deadline.
Okay. Question, and maybe this is not for, maybe this should be an executive session as well, but there were reports of a potential lawsuit about this plan. Was this the earlier divestment?
So again, I necessarily
definitely not for public session.
Yeah.
Check. I retract.
Thank you. Okay. Well, yeah, like this item was for just information purposes only. And again, the actual plans themselves are on the SharePoint site. Reach out to the Comptroller's Office, Bureau of Asset Management for other details as well. All right. So yeah, if there are no other comments or questions on that quick comparison, the next item on our agenda is a fund recommendation. Per Public Officers Law Section 105, 1H, executive sessions may be held if the discussion is about the proposed acquisition of securities or sale or exchange of securities. Be that as it may I have a motion to enter executive session?
Motion from John.
Thank you, John. May I have a second?
Second from Tony.
Thank you. Any final discussion for public session? None? All those in favor of entering executive session, please say aye.
Hi, Siri.
Hi, John.
Right. Any opposed? Thank you. Right. Any abstentions? The motion carries. We are now in executive session. Before we start the final portions of the agenda, we'll report out on executive session. In executive session, the executive committee tabled a recommendation for an opportunistic fixed income fund. The next item on our agenda is our second discussion on asset allocation. For those of you at the meeting yesterday, CIO Steve Meyer and Head of Risk Ed Berman discussed the various consultants' capital market expectations. So essentially a macro view on how various market participants see asset class returns and risk over the next 5 to 10 years. And I think their analysis and presentations have been posted to SharePoint for your review. And what I hope everyone is able to really kind of appreciate, appreciate is that, there's a lot of building blocks into making the asset allocation decision. And for folks who are joining for the first time, the asset allocation decision, how much we commit to various asset classes that in concert will get us to our target return is the most important investment decision that the Board of Trustees make after setting policy. And I think I want folks to really kind of appreciate there are a lot of building blocks into this as we're making these decisions, right? The kind of macro views and capital market expectations just being one of them. And so over the next several months, we're going to really continue to add additional information and viewpoints. But at the same time, we want to make sure we're continuously going back over the key takeaways. So as we're giving you more information, making sure that we're summarizing and synthesizing that information into portions that can be utilized. So really kind of thinking about those key takeaways. And I think, yesterday's presentation, I think, had a lot of commonalities, as well as meaningful dispersion between how the various consultants are seeing the world over the next 5 to 10 years. And adding on to that, I think, and where I think last month's presentations and this month's from the chief actuary can add additional insights is, how we really think about our overall risk posture, right? And so we're not today or last month, we're not really going over necessarily yet candidate portfolio. So we're not saying yet how much we should have in U.S. equity versus U.S. Fixed income versus private markets, but really how and why our risk posture over time can evolve. And I think that's really what we're setting up the stage. So starting with our risk posture and then moving into how to best express that risk posture through the asset allocation. And with that in mind, before I turn it over to Merrick to go over some of those actuarial assumptions that are so critical to how we think about our overall plan asset allocation, I want to remind everyone about the key takeaways from last month. All right. So the agenda today is really the key takeaways from the last meeting, and then going over the actuarial assumptions and risks from our chief actuary. So first, I want to talk about what were the key takeaways from the historical overview. The first portion of our of the meeting yesterday, where we talked about asset allocation, was really the historic overview. How did we get to where we are today? How did we arrive at that asset allocation over time? And so between 2009 and today, really, there are three major points for our historical asset allocation. First, more alternatives, so more private markets, less public equity. So we've moved over time into private markets, less into public stocks. And then in addition of that public equity, we put more into the U.S., less in an international equity. So we overweighted the U.S. market versus the international markets. And we invested more in credit, so more in corporate credit both in high yield and investment grade, and less in government fixed income. So really taking a risk on posture. And in addition, we're in much better financial position than we were than in 2009. Again, we were around 57% funded on a market value of assets base in 2009. So we've had substantial improvement in our funded ratio, and you'll see more of those details in a second in the next presentation. Contributions are as a percentage of payroll at their lowest since 2009. So the percentage of total payroll that's being contributed from the employer to the pension is at its lowest level since 2009. And as I said before, we are now cash flow negative, so we're paying out more benefits than we are receiving in contributions. Again, that is not saying that things are, this is not to say that things are dire. In fact, it just means we're a mature plan. Key takeaways from Siegel-Marco's presentation on capital market expectations. So we're thinking about macro considerations. Rising interest rate to combat rising inflation. So our starting point with rates are much higher than they were over any of the past 3 asset allocations. Lower global growth forecasts, and valuations are down in publics, and with some tempered interest in private markets. Even though vis-a-vis, I think there's still room to kind of move into certain alternatives. Under our current portfolio's assumptions are that of a 7.9% expected return. Again, this is using the Siegel-Marco's capital market expectations over the next 10 years, and then a 7.5% expected return over 20 years. Our discount rate is at 7%, and so, and again, the standard deviation around this is 13.2. Typical standard deviation, at least on a go-forward basis, somewhere between 12 and 14. And I think the big thing there is, and what I think drives into our last themes on investment liability risk is, do we need to take as much risk as we've been taking over the past 10 to 15 years? And so I think the key takeaways from Salil's presentation, why taking investment liability risk and adding that to our typical mean variance optimization is so important. So, it really augments our analysis, understanding the other side of the balance sheet and the co-movements of assets and liabilities. I think it allows for additional parameters versus just, kind of average return, average volatility in correlations and average correlations, or kind of a standard correlations. And understanding that, reduced return assumptions means if it's more costly if we get things wrong. And I think that's a big takeaway from Salil's presentation. And the conclusions are that we are close to or at our appropriate risk tolerance. So that, certainly we are not, I think we're moving in a direction where we're not going to recommend taking more risk. And again, that's taking everything into account. Active management plus non-traditional filters. So as we're making policy decisions, whether they're around environmental, social, and governance considerations, diversity, inclusion considerations, all else being equal, increase our tracking error, right? And so that adding in those components, we have to, if we have a formal or not informal risk budget, we should think about how, adding in those policy considerations have us taking additional active risk. And if we want to take that additional active risk, perhaps we take down active risk in other places. And then finally, that our strategic asset allocation assumptions may not represent our actual portfolio. So, and a very easy way to think about this is in the private markets, it takes us time to get to our target, like in private credit. And so our actual portfolio may differ from the strategic asset allocation in a number of ways. And so how do we account for those risks, either as we're building up to that allocation, or again, how policy decisions may meaningfully change our investable universe. Again, not saying we do not take those policy decisions, but we should take them into account holistically as we're building a portfolio. And again, all of those current indications, they're still, still a long way to go. And we're still, again, our consultants still working with the Bureau and having those discussions, but current indications are all pointing to taking down risk in the portfolio. Higher funded ratio, being cash flow negative, our kind of investment liability risk showing that we're near our risk tolerance, and again, the risk tolerance of the plan. We've increased our tracking error a bit and active risk a bit through policy. But at the same time, from a capital market expectation standpoint, we have higher starting base. So higher rates, fixed income is more attractive than it's been in some time. And that in addition with additional volatility kind of across the board, our take is that those signs are pointing direction of tamping down on risk on the margins. Again, we'll always still have to take risk given our actually assumed rate of return. But I think that's really what current analysis is pointing to. So again, I just want to set the stage that those are the key takeaways from last time. And so take all of that and then add it into, kind of what you're going to see next, as we're thinking about how does the a key player in this, the actuary, think about the assumptions, how do their assumptions play a role in our financial position, like funded ratio and the like. So just wanted to give you all that. Before I pull up Merrick's presentation, any questions before we turn it over to Merrick? All right, Greg, is that a hand or is that?
No, it's not.
Okay, so is there any questions for before we turn it over to Merrick? All right, well, all right, Merrick, I'm going to fire this up in a second, so you can maybe make some introductions as I fire up your presentation.
All right, thanks, Antonio. I'm assuming you can hear me. I was asked to do a 30-minute presentation on Actuarial 101, Actuarial Basics. So if I do my job, by the time I'm done, you will all be able to think and speak like actuaries, for better or for worse. I'm going to touch on exactly how we use these 7% actuarial interest rate, the discount rate, the assumed investment return in the calculations, so you can get a feel on how it impacts evaluations and get a feel for how all the different components to the actuarial cost that we provide. I was having some difficulty getting both my microphone and PowerPoint to work on the same PC, so Antonio's kind enough to run the PowerPoint.
Hold on, okay, there it is right there. But so for some reason, my save, I should have it now. Give me one more second.
All right.
Are we good?
Yeah, can you try hitting F5 and actually run it?
Yes, there we go.
Oh, beautiful. So I'll tell you next every time we want to go forward. Go ahead, next.
All right.
And so the agenda, actuarial basics, we'll go through this, then touch on the BERS valuation results, talk about some issues you have on the horizons and any Q&A at the end. Next. So I got animations throughout this. So, so we'll see how this works with me and Antonio communicating back and forth to get these running. But the first thing I wanted to show you is the basic funding equation. Whenever you ask an actuary, all right, what's the first thing people should know about pension funding? It's this equation: C plus I equals B plus E. So C is contributions. That's the realm of the actuary. That's what we do. We calculate the contributions. The I is the investment income. That's what you guys decide with your asset allocation and the investment returns. Everything on the left side of this equation is the money going into the plan. Everything on the right side of the equation, the benefits paid plus the expenses, that's the money coming out.
Merrick, we lost your voice.
I wonder if he can hear us, Antonio.
Merrick, can you hear us? You are, yeah, we lost your voice.
All right, can you hear me now?
Yes, we're good. You're good now. Yeah.
I lost your pictures too, so that was
Okay.
a coincidence.
Gotcha.
All right, so I'm not sure what the last piece you heard, but the stuff on the right side is what the actuaries like to think of as the cost of the plan. We have no control over the stuff on the right, the benefits paid and the expenses. But we control the stuff on the left, the contributions. So I wanted to run through some scenarios, especially since I heard some of the stuff discussed at the last board meeting. So the first scenario there is, what if you don't have any investment income? The green eye is gone. and you just have contributions equals benefits plus expenses. Well, in that scenario, it's pay-as-you-go funding. So many OPEB plans, post-retirement medical plans, they're pay-as-you-go. You're not trying to create an investment fund. You're just setting the contributions equal to the money going out of the plan. Next scenario is contribution being greater than the benefits plus expenses. So that's like in the early days of the plan, back when BERS started pre-funding your pensions, your contributions were greater than your benefits and expenses. That extra money went into a fund that you invested and created a reserve. Next. And now you're in a situation where your contributions are less than benefits plus expected. This is where you want to be. This is a mature plan where you're reaping the rewards of pre-funding. You're living off of the investment income. Next. And this is the last point on the slide. Is this a common mantra? I already mentioned it once. Pension actuaries say this all the time. Actuarial valuations don't change the cost of the plan, only the timing of contributions. So when we talk about, the discount rate, the 7% assumption, the probability of dying or retirement, none of that stuff changes the cost of the plan. The cost of the plan is on the right-hand side of the equal sign. All that changes is the timing of the money going into the plan, the stuff on the left-hand side. Next slide. So wanted to talk about how that 7% comes into play with the actuarial present value. And there's a lot of smart folks on this call, a lot of people with backgrounds in finance, and you're like, yeah, I know how to calculate a present value. But I want to show you the distinction between a present value and an actuarial present value. So I said, all right, assume we have a 7% investment return assumption. What's the present value of 100 paid from a year from now? Next. And that number is $93.46. Next. And the way we figure that out is, well, if you take $93.46 and you give it a year of 7% interest, that's what that 1.07 is, you get $100 at the end of the year. Now, when I put together this slide, I didn't do the math that way. I did it like Antonio's showing here. I took the $100, I divided it by 1.07. I said the present value is 93.46. Next. And that's how you get present values in the traditional sense. You discount that the cash flow, the number you're trying to get a present value of. Discount is another word for divide. So we divide by that 7%, the assumed interest rate, to get the present value. Now go ahead, next. And here's, I'm going to give you an example where we're not going to do the present value, we're going to do the actuarial present value. And so let's say it's same $100, but now what is it paid to an 88-year-old male and it's only paid if the person's alive at the end of the year, and assumed mortality is 10%. And I picked an 88-year-old male because that actually is right around the probability that an 88-year-old male will die in a year. It's like 10%. So what's that present value? And there's the math. You start out exactly the same as a regular present value. You take the 100 divided by 1.07, you discount it by the 7%, and then you multiply it by the probability of that payment being made. So the 10%, we call that the decrement, the mortality decrement. The probability you're not going to die is 90%. So we multiply it by 0.9, and we get the actuarial present value of $84.11. Next slide. So I use the word decrement. Go ahead, next. So what are decrements? Pension actuaries use this all the time, and I'll fall into the pattern of using the word when I present stuff. Decrement in Webster's is a gradual decrease in quality or quantity. Pension actuaries use this to describe the ways number counts can decrease in the retirement system. So next. So a retired member, we say when we value a retired member, it's a single decrement model. The only thing that can happen to someone retired is they die. All right. But now, and by the way, the retired with a single decrement model, that's a really straightforward model. We just did that a couple slides ago where we had the 88-year-old male. You discount it by the interest rate, you multiply it by the probability of that payment being made. That's it. You can do that in Excel. You can do, large groups of retirees in Excel. It gets way more complicated when you try to do the same thing for an active member. We call that a multi-decrement model. And because multiple decrements can happen, there's multiple ways that active can leave the system. Can die, can become disabled, withdraw, retire. So next, we're going to go on the next slide, and I'm going to give you an illustration of what the actuarial software is doing to try to calculate the actuarial present value for an active member. So I'm going to start out with a single active member. That's the green dot at the top. All right, next. And then what we do in year one, we say, what's the probability of all the decrements that can happen to him? So, and I color coded these so he could quit and maybe get a deferred benefit, be terminated vested. A person could become disabled, could die, could retire, or he could survive all the decrements and remain as an active. And so we'll say, we'll literally split the single person in our valuation into 5 fractional people. So if the probability of each of the decrements is 10%, we'll say 10% of the person is now quit. 10% of the person is disabled, 10% has died, 10% is retired. 60% of that person, we have 60% of the person still active, and then go ahead and hit year 2, then it happens all over again. The next year, we split all those fractional people up into more fractional people. So the one person goes into 5 fractional people, the 5 fractional people go into 12 fractional people. Each point in time, we're calculating, well, what's the benefit that the person's going to get if that event happens? We discount it with 7% to go back in time, and then we multiply that by the probability it's going to happen. So you can see the paths that you're doing these calculations on grow exponentially. And we move this person forward through time until we hit 100% probability of mortality, 100% chance of dying, and there's no fractional people left. So next, it's more complicated than what I'm showing you because this is kind of a simplified illustration. I couldn't fit all the dots on this page, but there's, we're not showing the beneficiaries. So if you can be disabled, you have a beneficiary, you die, your beneficiary starts creating fractional beneficiaries going forward. Same thing when you're retired. So not shown as a beneficiary, also not shown as your different types of retirement. You have early retirement, which has its own decrement probabilities. You have your regular retirement. So I try to keep the picture simple, but it's even more complicated than this. So keep going. So the actuarial present values are summed along all of these different branches to produce the valuation. Next. This is an important point because we're splitting people into fractional people. Actuarial valuations are never right. All right. Because you think about it, if I got a 10% chance of dying and I have 10% of the person dead, 90% of the person alive, well, that's not what happens in reality. Either 100% of the person dies or 100% is alive. So the very first year we do an actuarial calculation, we're wrong because there's no way reality can replicate the fractional people we use in the valuation. But there's this thing called the law of large numbers, where if you run an experiment, and it says if you run a trial over and over and over again, and you average the results, you're going to get the expected value. And that applies for actuarial math as well. If you have it might not make sense for one person, but if you have a large group of people and you run the same model through a large group of people, you're going to get the expected present value for the group. And the last point, actuarial gains and losses occur whenever reality is different from what is assumed, which is always. Next slide. So we've been talking about the actuarial present value. We refer to that as actuarial present value benefits, PVB. Some actuaries call it PVFB, present value future benefits. But there's another term people use synonymously, and they're actually 2 different terms with 2 different meanings, is the actuarial accrued liabilities. And when we issue fiscal notes, you'll see we say, well, here's the increase in the PVB, and here's the increase in the actuarial accrued liabilities. There'll be 2 different numbers. So PVB is the liability in today's dollars of everything they actually thinks will happen until everyone's gone, until everyone's dead. The actuarial accrued liability is the portion of that number that's attributable to the service that's already earned. So the PVB looks at all the service you have, all the service you're going to have before you die, looks at all your future pay raises and everything. You get the total present value benefits, but now we want to split it. We don't want to have you pay for everything at once. We only want you to pay for the stuff that you've already earned. So next point. So for anyone not earning any more service, so anyone who's not active, we call them inactives. For example, retirees or terminated vested members, the two numbers are the same. So the PVB equals the AAL because there's nothing to split. Next, but for active members, we have to do this split. So the entire circle over there is the actives PVB, and we have to split it between what's past service, the blue area, what that active is going to earn in the future, that's the orange area. And the way we use that, we use an actuarial cost method to determine the split. So next slide. Yeah, so we're trying to figure out where that split is between orange and blue. The actuarial cost method that BERS uses next is called the entry age normal cost method. I've been an actuary. I've been working with public sector clients since 1989. I think every single public sector client I worked with used the entry age normal method. It's the most common one in the public sector. And I want to kind of give you a feel for what it is. So the word normal cost is in the title of entry age normal cost. And normal cost is just that sliver of that orange area of the PVB that the active earns in the next 12 months, in the next year. So it's the normal cost is the cost the next year of service adds to that person's PVB. So the entry age normal cost, the reason it's so popular, there's so different methods and they have different properties. The property of the entry age normal cost method is it produces a level normal cost as a percent of pay, which is really useful for government plans when they're budgeting, when they're doing contract negotiations, that kind of stuff. Next slide. So, all right, how do we calculate it? This is going to be the most math out of the entire presentation. So if you can bear with me on this one slide, you're an actuary. So first of all, entry age. That's the age a person joins BERS. Next point, attained age is their current age. So we'll do a census, we'll collect data, and say we have a 40-year-old on the valuation date. 40 is that person's attained age, but suppose that person was hired at the age of 20, hired by BERS, or joined BERS at the age of 20. That's the person's entry age. At 20, we're going to back that person off all the way to entry age. We're going to create a hypothetical person that looks like this person when they were hired. So we'll take that person's salary. Go ahead, next point, and we'll back off that salary to entry age. We'll take his service all the way back to zero. We'll reset the employee contributions to zero, and we'll do a calculation. We'll calculate the present value of that new hire. We'll calculate the present value of benefits for that new hire, and then we'll also calculate new term here, the present value of future salary at entry age for that new hire. Now, present value of future salary at entry age, you can think of it as being like PVB. We're discounting with 7%. We're using decrements. But now instead of looking at benefits, we're looking at the pay the person's going to get as an active employee. And then to calculate this wonderful number, entry age normal cost percent, we're going to take the ratio of the two. We're going to take the numerator, the present value of benefits the new hire gets, and the denominator, the present value of salary the new hire gets. And so what you see there we're doing is we're saying, what's the benefit per pay? And so that's what the entry age normal cost is. It tells you for every dollar of pay, what's the rate you're earning pension benefits. Next point. Next bullet.
There you go. Yeah.
All right, there. So yeah, so I just said it. It indicates the average pension benefit for the dollar. Next one.
Mm-hmm.
All right, so for example, for BERS, the entry age normal cost percent for the entire group is 8.11% of pay. So every year, the normal cost for the entire BERS population is 8.11% of pay. But for tier 6 people, since they have lower benefits, it's a lower normal cost. So that's 6.4%. So what you're seeing here, we've been calling in the office, we have a term for this, it's called tier shift. So the normal cost as a percent of pay is slowly going down over time as all the new people come on, they're tier 6 people, the more expensive tiers decrement away. And so eventually over time, that normal cost of 8.11% of pay is going to decline and approach 6.40%. Next.
So one question for you, Merrick. You can talk about entry age normal. You can do it quickly. What are some of the other ways of kind of calculating the normal cost?
So it all goes back to the cost method. So another one used in the corporate plans is projected unit credit. And so what you do for projected unit credit is you take the entire PVB, that circle there, and I'm going to simplify this a little bit. If the person's expected to get 40 years of service over their career and they currently have 10 years of service, you just take a ratio, take 10 divided by 40 and say the accrued liabilities is 50%. And so that it's a different way of calculating the accrued liabilities, but then it creates a different pattern for the normal cost. The normal cost would become just kind of 1/40th of the total PVB, but that normal cost isn't a level percent of pay, so it's typically not used in public sector plans. So anyway, a couple of other points here. So now, once we've got so what we're trying to do here is see how the entry age normal cost is used to calculate the accrued liabilities. Once I know what every dollar of pay, what kind of benefit it earns in the future, I can calculate a new number, present value future salary at attained age. That's up in the kind of in the middle of the page. Multiply it by the entry age normal cost percent. That tells me, based on future pay, how much of a future benefits I'm going to earn. That number is also known as present value future normal cost. And once I know what the present value future normal cost is, that's the orange, I can subtract that from the PVB, and then the balancing item under the entry age normal cost method becomes, the blue. So like on the projected unit credit method, which I talked about before, you calculate the blue and you balance on the orange. On the entry age normal cost method, you calculate the orange and then the blue becomes your balancing item. So each of these funding methods have a different way of calculating the split between the two. They calculate one piece and the other piece becomes a balancing item. So now unfunded accrued liability. So the whole point of that previous slide was to come up with, well, we got to figure out what portion of the PVB has been accrued. And now we figure out how much of it hasn't been paid for. So we can take the total accrued liabilities and then we just subtract off assets to get the unfunded accrued liability. And that slide, that graphic on the right-hand side, that's to scale. And that's based on your last valuation results. Your BERS accrued liabilities were 6.1 billion. The market value of assets was 5.9 billion. So you have a sliver of unpaid for accrued liability, that UAL around 200 million or so.
Absolutely. One thing on that, Merrick, I just want to focus is oftentimes you will see our total assets as $8 billion. Just to let you all know that a portion of that is the fixed TDA asset. So right now we're just talking about the qualified pension plan assets. Just so if anybody had any questions on why this number is smaller than the total assets that you'll see in the Bureau of Asset Management's presentations.
Thank you. Perfect. And so there's actually two assets we use in the valuation. We're just looking at QPP assets, but there's an actuarial value of assets and a market value of assets, and we publish both. And the graphic over to the right shows you the market value of assets for the QPP, but the concept around the actuarial value of assets, which is actually what's used to calculate your contribution rate, is that there's volatility in the market. There's a 7% assumed assumption. So, it's hardly ever that you exactly earn 7%. So one year you're above 7%, the next year you're below. If we use the market value of assets to calculate the contribution rate, it would create a lot of volatility in the employee contribution. So, I said like the entry age normal was every one of my plans I've worked on had the entry age normal. The AVA smoothing method, the actuarial smoothing method, that's something else that almost all public sector plans use. BERS is no exception, where you take 1/5 of every investment gain and loss. You're basically smoothing all the investment gains and losses over a 5-year period. So the big loss that occurred last year, 4/5 of it, we're going to assume happens in the future, so we don't include it now. The big gain 2 years ago, well, since it was 2 years ago, we recognized 2/5 of the gain, and 3/5 of that gain we're not recognizing until future valuations. So we use the actuarial value of assets, not the market value, to calculate the unfunded, and then we create an amortization table to pay off the unfunded. Next slide. So here's your amortization table from your last preliminary report. First row on that is back to one of the prior chief actuaries back in 2010, when they switched to the entry age normal method, created that first row in that table. That was the initial unfunded actuarial accrued liabilities. So that was going to be amortized over 22 years. The way it was written in statute was that payment was going to increase 3% a year. So you see that fiscal year 2024 payment was 141 million. For fiscal year 2025, that's already predetermined to be 3% higher. It's going to be 141 million times 1.03. Now, because every year we know actuarial gains and losses happen because our assumptions never match reality, we add a layer, we add a row where all the differences are amortized. And there's multiple ways there could be differences. There could be actuarial gains and losses, including investment gains and losses. Those are amortized over 15 years. We could have an experience study and say, oh, people are dying at different rates, and we have a new mortality table. Well, as soon as I go back and I change the mortality decrement, that'll change the accrued liabilities, which will change the unfunded, and that delta gets shown up in a row in here, and we amortize that over 20 years. There's a benefit change. We figure out, well, how did the benefit change impact the accrued liabilities, and we'll amortize it over the future working life of those impacted. Next slide.
Merrick, quick question on that. So we have that initial UAL 2010, there's 9 remaining payments. What happens when that runs out?
It's gone. It just drops off.
Okay.
That row disappears.
Okay. Gotcha.
All right. Next slide. And we're going to see a graph where you actually see what happens. They're coming up.
All right.
All right. Components. So we're back to our friend, the Red Sea from the first slide, the actuarial contribution. There's 3 components to this. Go ahead. The normal cost. We said this is the sliver of the PVB over the next 12 months. Next. And we talked about how that's the entry age normal cost percent times the pay for the next 12 months. Next. Now we have the UAL payment, which is the sum of all those payments from the amortization schedule from the prior slide. And next. And the third component of your contribution rate is the reimbursement of the administrative expenses with interest. Next slide. Contribution rate lag. So there is an intentional 1-year delay between the valuation date and when we actually charge the city and the obligors to make the payment. That's intentional. That's common in the public sector. That's just to allow us time to collect the data from you all, from the results of your investments, the people, check the quality of the data, run the mathematical models, and produce the valuation. But then we produce the results, and we include 7% interest on those results to make up for the delay. Go ahead next. So we give you 2 numbers. Before the fiscal year starts, we give you your preliminary number, and then before the fiscal year ends, we give you the final employer contribution. Down below here is your preliminary contribution for fiscal year 2024. And by now, you should be comfortable with the headings for each of those columns. You know the normal cost is the amount that the actives are going to earn for the next year. You know the UAL payments or the sum of the payments from the amortization schedule. You know the administrative expenses are just a reimbursement with interest of the expenses you spent from the QPP. Next slide.
Can I just ask a question, Mark?
Yeah, go ahead.
How much interest? I don't think I realized our administrative expenses included interest when we repay the city. Do you know what is the interest rate?
Yeah,
and
it's
is,
7%.
and are
it's
those interest rates included in our budget, or is that separate?
Yeah, they're included. So it's 7% interest. So this 40 million that you see here, this was what BERS reported to us was deducted from their QPP for administrative expenses before, this is after interest. So I think it was like 35 million before interest for the valuation year ending June 30th, 2022. All right. So then we take like that 35 million and we say, well, that on average occurred in the middle of the year. The city is going to reimburse that or put that back in the middle of the 2024 fiscal year. So there's a 2-year delay between, on average, when the expenses came out and when they were reimbursed. So we'll take what BERS reported to us and add 2 years of interest at 7%. Now, what happens in NYCBERS in the 5 systems, it's a little different from some other public sector plans. Other public sector plans will deduct the money and not have a line item. They won't be transparent. So the employers won't know how much was deducted. It just flows into the actuarial gain and loss. And then it gets buried into the UAL payments. And then the employers all get charged for it because it's part of the UAL. Here in New York, there's actually, per statute, we have to add that expense and have it reimbursed from the obligors as part of the annual contribution.
And so that's interesting because that means that conceptually, if it gets kind of added into the UAL and it ends up being amortized over a longer period of time.
Yeah.
At other places. Okay.
Yeah. And you already do this with part of your investment expenses.
Yeah.
We say it's 7% net of investment expenses. If you go look at the CalPERS report, they'll say like I think 6.8% net of investment and administrative expenses. So it just kind of flows into the UAL payment. All right, next slide. Common misconceptions. You can just start hitting through these pretty quick. A lot of people will think, well, new hires are already included in evaluation results, and this came up with the open enrollment fiscal note for BERS. And new hires aren't. Funding valuations are closed group next, and we're only valuing the people in the closed group. So whenever extra people show up, there's a normal cost form, and you can see the normal cost for the tier 6 people is 6.4. Next, assets in the valuation are projected forward with that 7%. In the whole slide, you've never seen me take assets and roll them forward with 7%. And we don't do that. In our valuations, we take liabilities, payments in the future, and we discount them back with 7% to get back to the valuation date. Next. So we discount them back. Next. And now we compare the assets and liabilities on the same day, apples to apples. Next, but the implication there is, if assets earn the discount rate, then there's no investment gains and losses, and everything works out. So there's kind of a buried assumption that the assets are expected to earn 7%, but we're really never doing anything with the assets. We're discounting liabilities by 7%. And you can just skip through these. I already talked about the actuary doesn't determine the cost of the plan, just the timing of contributions. Next slide. And this is, comparison of BERS to the other 5 systems. This was from an exhibit. This is all public information, so I thought I'd show it to you. Key thing to point out for BERS, you were overfunded in 2021. This is based on market value. You're just underfunded in 2022. In my opinion, in my head, I think of BERS as being fully funded. And if you have a good year, you're going to be overfunded. And if you have a bad year, you're going to be underfunded. You're going to be toggling right around that 100%. And when you're overfunded, the amortization method creates credits that you can use to offset your normal cost. And then there's a downward pressure to get you back towards 100% funded. Next slide. And this is the final slide. These are a couple screen grabs, screenshots from the preliminary contribution I presented to the board in March. I just want to point out issues on the horizon. You know, that schedule and the amortization, you're asking what happens when that first initial UAL is paid off. You can see that in the graph in the year 2032 and 2033, it gets paid off, and all of a sudden the contribution drops. And so what this shows is the sum of all those amortization payments and what happens when each one of those is paid off. And this is all determined in statute. And it's kind of funny, between now and 2032, because of how those layered amortizations were set up, you're contributing like 357 million so that you can get 488 million back in the 7 years after that. And I can't do anything about it because in statute, if it wasn't in statute, I could do things like fresh start, where I could take all that 488 million in credits that occur in 2033, slide it all the way to the left, take the present value of that, and use that to discount or to reduce that 357 million that you're paying before 2032. You know, so if I did that, that'd be like reducing that 357 million by 274 million. That would be like the present value of the 488 million moved back in time. One point before everyone gets excited about all this money in the plan, remember we got the asset smoothing method, and so we're not recognizing some deferred gains and losses because the last year was a bad year. It's more deferred losses. And so there's like 428 million not recognized in the amortization schedule above, because we're not using market value of assets, we're using actuarial value of assets. The concept is, though, there's a reversion to the mean, and then, you know, you have some bad years followed by some good years, and so it'll work out over time. But I wanted to point it out, it's not all, you see that big $488 million credit there, it's not all roses. So anyway, I went 8 minutes over, but I'll stop there and see if you have any additional questions.
And so I wanted to see this real quick. And so another just a quick question on where are these exhibits? Because, you know, obviously we're going to make sure everybody has these presentations posted on SharePoint and in your files after this is over. But in addition, if anybody wanted to see where these schedules came from, where are they?
So they are a couple places you can see them. So on our website every year when we publish the final valuation report, there is a chart in there that shows the payment of the UAL, the one on the right. It's harder to read because it actually shows every base, and I decided to simplify it going forward just to kind of show the totals so it'd be easier to see the grand total. But it's on our website in our val reports. The cleaner version is in the appendix of your preliminary contribution letter that I presented to the board in March. And going forward, I'm going to include this cleaner version in all the future valuation reports that are published on our website.
Perfect, thank you. So, and then one last one is that you know, certainly that's the, you know, looking at both kind of the credits and the amortization tables right now certainly seems to imply that you know, our cash flow can drop substantially. But are there, you know, certainly if we were to think about in a open plan model or other things that could occur that may change that, is that strictly investment gains that would, in gains and losses, and recognizing those that would change this? Are there any other things that could change that table on the left?
Yeah, the investment gains and loss are the biggest mover. So you think the New York City, the NYCBERS retirement systems are the most audited plans in the country. The comptroller hires an outside actuarial auditor to look at the assumptions every 4 years. So every 4 years, people are looking at our rates of mortality, rates of withdrawal, rates of disability. And so it's pretty dialed in. You know, we're pretty accurate at predicting how people decrement. What we have no control over is the investment gains and losses, you know, or that I should say that's the biggest unknown because we know they're volatile. So yeah, so going forward, it's going to be driven by the investment gains and losses. But I'll point out again, that's just an assumption on our part. It doesn't control the ultimate cost of the plan. You know, whatever the assumption we use, if it's right or wrong, it's just going to shift the timing of the contributions, the stuff on the left-hand side of that balance equation we started with.
Absolutely, thank you. Appreciate it. Any questions for Merrick on any portion of this presentation? And like I said again, this will be posted for you all.
Yeah, I have my hand raised, Antonio.
Oh yeah, go ahead.
Yeah, so you know, as a one of my friends, a former predecessor of yours, Mr. Tiskevich, said was quoted as saying, actuarial science is akin to voodoo. I sincerely appreciate you taking the time to demystify this, because this was really excellent presentation for a pension nerd like me. My question was in regard to the 2033 ending, and for some of my fellow board members who don't know about this, I was told, and maybe this could be corrected if I'm wrong, that this deal was struck that that basically the city must make up everything up to that discount rate, even if we fail under that up until 2033 because of the union, the pension fund bailout of the city in the 70s. That was a deal that was struck years ago, and we're coming to that end now. Do we foresee that after 2033 that continuing in the same method, or do we see something different? And if that is the case, Antonio, even though we've been talking about this a lot over the last few weeks, it changes kind of my ideas about asset allocation, right? Because if we're basically operating with a net until 2033, shouldn't we continue to try to generate higher returns and higher risk profile until we no longer have that net? Then we can kind of de-risk the portfolio and hopefully, you know, amortize down with the gains that we've had in the previous, in the next 10 years, hopefully. I mean, a lot of it based on context, but yeah, you got where I'm going.
Yeah, and Merrick, I can't answer the first part. I can answer the second part though, or at least attempt to answer the second part. But I'll let you go on the first part.
So the first part, the amortization bases are locked in statute. There's nothing I can do. So it says, you know, the actuary determines the amount of the base. So every year we say, all right, so Bob North back in 2010 said, here's the amount of the initial UAL. As soon as he determined that and put that first row on the table, that's in statute. You have to pay it off all the way till the last payment's 2032. And then in statute, it says the actuary determines what's the gain and loss for each one of those causes. Once I determine what the gain and loss is, then how that's amortized is locked in place. And because BERS has had more gains than losses, it's created this schedule of credits into the future, because that's how the law says, you know, it's a 15-year amortization, and the 15 years takes us past 2032. So now I got some credits that are accumulating back there. Now it's easy enough. Someone could change the statute, give me the ability to fresh start, and then I could say, all right, what fresh start means is you just collapse all those rows back. You basically delete them, start all over again. And you say, all right, what's my new one funded? Amortize that over a period of time and start fresh. And every new investment gain and loss becomes a new row, which contributes to this, like this chart. I don't know if that makes sense, but
yeah. Well, so, but I guess my question was more about the city's ability, or the city's mandate to make up any losses between our discount rate right now, right? Am I correct in this?
Yeah.
The city makes up any differences between what our actual performance is and the discount rate. Now, fortunately, we beat that. But now, so after 2032, we will have some credits hopefully realized from the great success of Sandy and Daniel and Antonio. But you know, and hopefully that will continue in the next 10 years as well. But what happens after that?
Yeah, so back up, Antonio, if you could back up a couple slides to the amortization table.
Absolutely.
While you're backing up, can I just say one thing? Because I want to, the city is like based on the state constitution required to put, like, we are required to pay the defined benefit that people have earned over the time of their work in the city. and that's in the state constitution. So like if there are losses, and like ostensibly the city always has to make them up because somehow we are always going to, you know, be paying the benefits that workers have earned.
Exactly.
Yeah.
Okay.
Okay. I've heard that
Yeah,
that was not ironclad, but that's interesting. Oh, that's interesting.
Yeah.
So
And let me just add though, so on this table, you can see every time we charge the city for those losses. Right? So it's those rows that say gain and loss. And so in 2022, we had a net, it was a net gain for BERS. Even though the investments were a loss, there was deferred gains from prior years, right? So the net recognized was a gain of 44 million that was amortized over 14 payments, 15 years because you skip the first year and just give it interest, but 14 payments, and that created a credit that reduces the city's contribution by 5 million. But you could go up and down the table, and you can see where the city was charged for a loss and where the city got a credit for the gain. And as Allison said, then they're required to pay it.
I just want to be clear. After July 1st, 1940, membership in any pension or retirement system of the state or of civil division thereof shall be a contractual relationship, the benefits of which shall not be diminished or impaired. That's the exact quote directly from the state constitution. So there's no question about what benefits.
That's good info.
Like that's pension 101 in New York City.
I guess the question would be how that manifests itself after 2032, I guess, right?
Nothing changes because
nothing changes.
After 2032, that first row disappears, all the other rows remain, and we just keep adding rows for gains and losses. The only time those rows disappear is when the payments go to zero. So every year the number of payments drops by one after the city makes the payment. So this table will continue to grow in perpetuity. And every time there's a gain or a loss for investment, a new row will get added, and the city will pay that or get a credit for the next 14 payments, 15 years.
Hopefully it's credits. Thanks very much. I appreciate it. I appreciate the whole presentation. Thanks very much.
And then, Mayor, just to be clear, that initial UAL was from the discount rate drop, correct?
I think there was a funding method change too.
Okay. Both those together? Okay.
Yeah, I think there was a whole package that occurred.
Okay. Gotcha. Thank you. And, you know, and obviously I said, you know, everybody get this presentation. I'm seeing other hands up. Any other questions for Merrick? Like I said, we wanted to make sure everybody got some kind of actuarial 101, pension 101, as John said, you know, kind of a decent background in, you know, the other side, so to speak.
Oh, no, that was awesome.
That was great.
Yeah, I have a quick question. In regards to how is the data used? So for instance, I'm assuming contribution rates, if we have a younger pool of talent going into those positions, the contribution rate, we get a longer benefit of them, right? So they're young, they don't need benefits paid unless they have a life incident. So the duration of the contribution rate. So do we take that insight and share it with the DOE HR teams, and like how do we kind of stack the deck a little bit with the data to make it so that we do have credits always in the future, I guess is my question.
So from an actuarial point of view and how that impacts the contribution rate, you're absolutely right. In general, younger people have a lower normal cost. So remember, normal cost is the average cost for a new entrant. We're using the entry age normal cost method. So the younger the people are, the longer working careers they have, the more time the city has to accrue or pay for their benefit. So as a percent of pay, the entry age normal cost is lower. So if you hire a bunch of younger workers, eventually the normal cost will trend down to a smaller number. But other than that, we have no reason. We don't.
Program. I'm just about the various initiatives. I've seen apprenticeship programs and I've seen different initiatives to get young people working. but I haven't seen any intentionality with maybe the base of BERS.
Tony.
So I'm curious. Oh, sorry. Or maybe someone knows that I don't know.
Yeah, no. So, and I think from that perspective, it's because being trustees on this plan, kind of seeing how the sausage made, so to speak, and how ultimately we think about investment strategy given the actuarial assumptions is completely separate from kind of the front facing on how do you get people to come work for the plan, because all they know is the benefit, right? They know here, if you work here under tier 6, here's what you're going to get, and that is I think a separate method than how do we end up paying for it, right? And I think that's kind of the biggest key, where it's the how do we get people into the plan and how rich is this particular benefit, is kind of that front facing conversation. This conversation around all right, we've promised X, now how does it get paid for? And so that's where I think the yeah. So.
I think that to me is the connection, right? Because what you're investing is based on, some of it has risk, but it also has a opportunity to be more lucrative. But if you don't have a window of time to research, make the risk, and test out things, you're always kind of behind. You're always going to be in a little bit of the red, but you need a window of time. So you need more contributions that's going to be in the system over a duration to give you the flexibility to make investments, rather than be risk adverse, right? So one complements the other, I guess, in my mind.
Absolutely.
Okay. I was just curious how one informs the other and how it shows up, because we sit in the seat where we're hearing about different initiatives and different things, and then we're attending these. So we need to kind of understand how one connects to the other consistently. I don't know if my other panel members feel the same, but that would be helpful for me. All right, thank you.
Absolutely. All right.
Absolutely.
All right, cool. Any other questions for Merrick? All right, Merrick, thank you so much. I apologize that, sometimes I didn't skip because I go ahead because I was listening intently to some of this information. And so thank you. And like I said, for the rest of the trustees, make sure you'll have this information and kind of a key takeaways on SharePoint.
Thank you for your help, Antonio, and thanks for everyone for listening. I'm going to jump off. I got another presentation that I got to run to.
Absolutely. Thank you.
All right. Bye, guys.
So I do hope everybody, got something out of that particular presentation. Because again, I think as we're thinking about risks, risks to the plan, and certainly, kind of the investment portfolio plays a critical role there. But as we're looking holistically at risks, understanding, what what contributions look like, what could be shocks to our funded ratio, I think is really important. And as me and Salil have said before, the Office of the Actuary was incredible in helping us to develop what we call an open plan model that allows us to, for contribution purposes, they look at what's been earned, but for planning purposes, it is helpful to see, all right, in a plan that's continuing to hire people, that's continuously open, how does that look into the future, and what are the ways that assets and volatility of our portfolio can contribute to to our funded ratio. So, like I said, they're always open. Make sure you ask questions. You'll get this information soon. And so that is the next to last portion of the agenda. If there's any final questions on that before I turn it over to Sandy for the last item for today.
Yeah, there's still some hands up. Allison, Tony, Michelle, did we cover all the questions?
Yeah, sorry.
Okay.
Right,
So to me,
Sandy. Yes.
Okay. So the executive committee has responsibility for investments and also some peripheral responsibility around the budget. I wanted to share two things. This will be shared with trustees in the next week or so as we finalize the information about the TDA Roth project. We still don't have a final estimate, but what we do have is a plan to charge those expenses in terms of system development to the TDA Reserve Fund. just so that people understand, there are two types of expenses that pensions have to pay for. One is business expense, the other is settler expenses. Settler expenses speak to those fees that must be paid for by the sponsor being New York City, for the Roth project. Any expense leading up to the decision that trustees make to actually perform these changes and adopt these changes to the system are paid for by the sponsor. Expenses incurred in pursuit of service of administration to the members is paid for by the members. We can facilitate those payments through a reserve that has been built up over many years of the TDA. We'll provide more information to trustees about this, but just wanted to give you a quick preview on this. This parallels actually what TRS will be doing with their Roth improvements to their system. Understand that both TRS and BERS are the only two systems that have a defined contribution sidecar 403B plan and are, the ones pressed on this issue of Rothification coming from Secure 2.0. Daniel, I'm not going to ask for any vote. This is just for information purposes. The other thing is that with that information, we have been answering questions from trustees on the budget proposed last month, or is it still? Yeah, it's still May. Sorry. This month, we are planning a June 13th vote on the budget. The executive committee has the ability to recommend that budget if it so desires, because we can't vote on that tonight because John Maddock is not. Well, is John Maddock here? I see John. We do have the ability to vote on that. I'd ask if the executive committee has any questions, because in the charter, the executive committee has the ability to recommend the budget and approve some components of changes in the budget. But I'd ask if there are any additional questions from trustees.
I have one, Sandy.
You're not coming through, Allison. Allison, we can't hear you. John, there any chance you know what the question is Allison wants to pose?
I don't know what her specific question is, but I actually have a question, which is if the assets for the TDA are housed solely at teachers and teachers is doing the upgrade, why would there be a cost to BERS? I know BERS has members, but all of the administration is done by TDA, by TRS, and all the money's at TRS. None of the money, my understanding was none of the money was actually at BERS, and the administration was done by the other agency. So I just wanted to understand if there was some piece I'm missing, and if you could just clear up. Yeah,
you are.
Yeah, and sorry, just to jump in before
there you
can
are.
you hear me now?
Yep.
Okay. I was wondering what the source of the reserve that we're spending for Secure 2.0 is.
I would ask for an executive session on that question if we want to discuss it in this call. But let me address Mr. Dorse's question. TRS executes the administration of the investments of the variable A, which our members can invest in as a component option to their TDA allocation. Generally speaking, it's about 25% of our members opt for variable A over the fixed. The fixed investments are pooled with our QPP and constitute a leverage component in our QPP investment. And we handle all the administrative transactions related to the TDA, enrollments, allocation changes, loans, repayments, RMDs. The only responsibility TRS has is investments in the variable A.
Gotcha. Thank you, Sandy. Appreciate that.
Yeah, John, anytime. If we wanted to have a conversation about how that reserve was created, I would ask for an executive session. Effie, can I answer your question?
Yes, you can answer it, or maybe John. It's a little bit what was presented a little bit earlier by John. I'm kind of admitting my ignorance here. I know about investments, but not less about pension funds. When it comes to the actuarial projections that John was showing us, what are the two biggest assumptions? Is it like how much money will be paid in over the next 20 years and how much money will be, like how many people will retire at what age and how much their benefits would be? Are these like the two biggest actuarial projections, or there's more to it?
Want me to take that, Sandy, or I don't know if you want to.
Yeah, go ahead, Antonio.
I mean, the single biggest ones are, you know, how many people are hired, how long they're going to work, and what they're going to make, and then how long they're going to live, right? Like, I mean, that it's really, you know, big picture. You know, who works here, how much they're going to make, how much they're going to earn in retirement, and then how long are they going to live is the biggest projections.
Yeah.
It's basically how much money is going to flow in and how much money will flow out. That's like the gist of the two, like the balance
Yes.
of the two.
Yeah.
The rest are details, basically.
Yeah.
Exactly. And to point back to something that Merrick had on his second slide, I think, all the actuarial analysis does is change the timing of cash flows. It does not determine the cash flows. So the cash goes in because the cash has to go out. And it's what the actuary does is determine the timing of the inflows.
And what the city might have to kick in, is that taken into account also as a probabilistic model, or that's not considered?
Not
That's an
probabilistic,
outcome of,
no.
that's an outcome of their actuarial
Yeah.
analysis.
And the reason not probabilistic is because, you know, if you think about the primary from but it's because a lot of this is around kind of budgeting, right? You don't want to blow up a budget, right? And so it is the idea that you can smooth out many of those, you know, kind of gains and losses. I think so. Yeah, thinking about this in many ways as a budgeting tool, and so I do think that that's you know, a bigger factor. So you're not looking, and now certainly we'll look at certain things that are probabilistic, but yeah.
Yeah.
All right, thank you.
The probabilistic stuff, Effie, comes in our asset liability modeling. Recall that the actuary just assumes a 7% return, right? Let's just assume that. So, yep.
Okay, so, all right, so it's basically like all deterministic, nothing stochastic in the actuarial model.
So, Effie, I think that's a question better directed to Marek. I know that the actuary does studies about the mortality experience specifically at each retirement system, and that these are baked into the analysis, but I'm not in a position to explain it to you.
All right, we can maybe explore that later. Thank you very much.
Yeah. And what we can do is we can talk about the upstart of the reserve fund from the TDA at the board meeting on June 13th.
I think we should have fiscal ops there, Sandy.
Of course, of course.
Right.
That's
Well,
it.
It is now 3:03. Thank you, Sandy. And so the last thing we need is a motion to adjourn.
So moved, Giordano.
Thank you. We have a second.
Second from John.
All right. All those in favor of adjourning, please say aye.
Aye, John.
All right. Any opposed? All right. We are adjourned. Remember, our next meeting is scheduled for in person Thursday, June 22nd, 1 p.m. at 55 Water Street, 50th floor. Thank you and have a wonderful rest of your day.